What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is January 31st of 2022. Well, folks, I hope you all are having a fantastic day wherever you are, and in today's video, I want to try to answer one key question on the minds of a lot of people in the crypto space. Have we entered into a crypto winter? A period of time where prices are going to be stagnant, we're not going to be seeing any rallies, and worse off, we may even see the entrance of a bear market. This has been on the minds of many people and many content creators in the crypto space due to the Fed's recent decision. And while it does give good cause for concern when the Fed is going the opposite way, we need to spend some time diving into history. We're not going to think with emotions or oversimplify things here. So if you guys are interested, stay tuned. It's going to be a really good video. And if you happen to like it, consider dropping a like, subscribing, sharing with a family or friend member, and make sure if you haven't already to hit that bell icon so you don't miss another upload here on the channel if you guys like listening to me ramble. All right, let's go ahead and kick off into it, guys. We've got a lot of things to dive into. So I don't want to so much focus here right now on the current price action of the market. I think that's the first mistake people are making when analyzing this question of a crypto winter. What I think is much more important to analyze is going back in history, because we've been through periods where the Fed has gone through quantitative easing, and we know what that does to asset markets, but we have also gone through periods of time where we've gone through quantitative tightening. I know it seems sometimes that the Fed is just always going vertical in the sense of printing new money and lowering interest rates and trying to stimulate asset markets, but there have been periods of time where that's not the case. Predominantly back in the early 2010s, going into more specifically 2015 to 2019. This 4-year period was characterized by a mixture of two different changes that we're hearing the Fed talk about again. The increasing of interest rates, increasing the base cost of capital, right? And outside of that as well, along with that, reducing the Fed balance sheet, starting to again sell off, in this case, or excuse me, buy up, so sell their bonds on their balance sheet, selling off the mortgage-backed securities, now injecting, in this case, more assets into the market, more supply for assets, and reducing the amount of cash, easy money in the system, right? So let's go ahead and just take a look at history. I think this is probably the most important thing we could do here. First off, let's go ahead and analyze the thing that the Fed is much more confident about here in the short term. They're saying that in March, they're going to start raising the federal funds rate, the base cost of capital in the economy. So the Fed's fund rate back here in 2013, 2014, going into the early part of 2015, had been basically near zero, anywhere from around 0% or fraction of a percentage up towards its first bump up here, right? Which we saw in January 2016, or if we really roll it back here, the last bit of December here towards the entry of the new month, okay? So generally we started raising rates and there were multiple rate hikes, right? So this conversation of the Fed raising rates, all the while we do believe that we want to wait until the Fed does what it says it's going to do. We want to see it walk the walk, not just talk the talk, right? But again, even if they start to raise rates, it's not the end all be all for assets. We can see here that for multiple years until 2019 and the late part in the summer, only then did they start to begin lowering rates. And this was, bear in mind, before the pandemic, right? So a really interesting thing here that the Fed has gone through periods of time where it raises rates and declines them. And it was on a general trajectory to the upside, I would assume. But we can see here that for many years, right, this can continue going on. Well, what did it do to asset prices? More specifically, what did it do to crypto? That's our topic for today. Well, I'm going to go ahead and map it out for you guys here. We can see here, when we take a look back here, at the initial rate increases for the Federal Reserve, we're going to go ahead and draw them here on our chart. So we'll go ahead and get the line tool here, and we can see here that we started raising rates back here for Bitcoin. Go ahead and, sorry, I'll get my get these adjusted properly. I forgot I'm using the same chart here for the QE, so you guys might have gotten a little bit of a spoil there. But anyways, we're going to focus here more specifically on the Fed and their management of interest rates. And we can see here, if we go here to the side, I think it was here in August 2019 when they started to reduce it. That is correct. So we went into the summer there. Let's go ahead and take a look at what Bitcoin did during that time. And then we'll take a look at total crypto market cap. You guys notice anything? Well, as we go across time, of course, on any given chart, this is when the Fed started to increase interest rates. And this is when the Fed stopped increasing interest rates. Certainly there was a bear market in between for crypto, for sure. But Bitcoin during that period of time went from around $477 all the way up towards 11,000. And if we're really considering the peak price potential that it had during that period of time, it went all the way up to 20,000 practically. So Bitcoin did a 40x in market cap, right? From around $500 to $20,000 during that period of time. And it's still, by the time the Fed started lowering interest rates and reversing the trend, was sitting around $11,000, $12,000, give or take. Doesn't sound like it killed Bitcoin by any degree. And not to mention, Bitcoin was a much smaller and more fragile market at that time, right? Again, some people might beg to differ and say, being a smaller market, it didn't really get impacted and stuff, had more growth potential. That's a very fair point as well. But we can obviously see that this isn't some doomsday scenario that killed crypto as an asset class, nor did it dramatically affect equities. Equities, of course, had their typical pullbacks, just like how crypto and any asset does. But it continued to chart at new all-time highs. So let's go ahead and dive a bit deeper here. Let's think about the next adjustment that the Federal Reserve can do, right? We understand that people are confident the Fed is going to start raising interest rates. They're really sticking to the Feds where they think the confidence is strong. The economists out there are really believing it. Let's go ahead and talk about the next thing here we could also discuss. I also wanted to share as well that we could take a look at the valuation range here for total market cap. Again, 7.5 billion upwards, close towards around 391 billion. You're talking about more than a 52x here, right, in valuation. So that's one thing, right? Now, if we take a look here at the next thing, which is going to be the Fed balance sheet, we can start to get some really interesting insights. So let's take a look here first at the Fed balance sheet over time. Now, when we take a look at history, this line is in a general uptrend. But there was a period of time, again, where the Federal Reserve predominantly was leading the trend here and reducing their balance sheet back in 2018, 2019. We covered this here on the channel quite actively back a couple years ago. And you can see on the global central bank measurement of balance sheets, right, which is now peaking at 31 trillion, back here around the 20 trillion mark, we started to go down towards around 19 trillion, about a $2 trillion global reduction in the balance sheet, right? Now, this, to many people, is seen as like really the catalyst point for leading assets into a total bear market. We're removing the funny money out of the economy. There is now a reduction of base money, and therefore it is going to be likely that there is less credit circulation in the economy, right? Or at least it's not as easy as it was before. So let's go ahead. Let's dive in here again towards taking a look at some of what the experts are saying. Some, for example, Goldman Sachs, one of the largest financial figures out there in the United States, stating from their analysts that the Fed's going to rate hike 4 times, up towards 1% here at the close of 2022. And they're going to start reducing the balance sheet in July, estimating that they could be reducing $100 billion per month, or some degree of billions of dollars. Well, let's just go ahead again. Let's just take a look at what happened here when the Fed was starting to, on a routine basis, reduce tens of billions of dollars from their balance sheet, right? They're starting to reverse the same policies that had built up the balance sheet. So they started back here in around February 2018, and they stopped here in around August of 2019, right? So you're talking about, give or take a little over a year and a half here, okay? Let's go ahead and take a look at Bitcoin's price during that same period of time. So we started off the balance sheet reduction over here in February of 2018, and we stopped the balance sheet reduction over here in September 2019. Is it just me, or is that around the same price range when they closed it as to when they opened the reduction of the balance sheet? No massive bear market by any regard. And bear in mind, this was not a good timing for the Fed to do this because crypto was, well, in a bear market, right? It had its parabolic peak here. Now, I'm not going to sit here and say that the Fed reducing its balance sheet was per se a non-event, right? I have no doubt that it definitely weighed down pressure on the crypto market, and it might be as well why it took a little while until we really saw the full-on rally for crypto markets. But to say that this was the thing that was holding crypto markets back would just be foolish. It's foolish. The reason why crypto markets were stagnant is, well, they were going through a bear market at the time. It had its parabolic peak euphoria, the media hype, the liquidity surge into crypto, the thing that drives bull markets, buy-side pressure, had completely exhausted itself People were reflecting on crypto markets at the time and looking at how much craziness went on. Everyone left and right was raising initial coin offerings or ICOs at ridiculous valuations with nothing more than a white paper and a team that may or may not have had long-term ambitions to do something meaningful. So we can see that the Fed balance sheet, and also especially interest rate hikes or reductions, don't really have as dramatic of an effect on crypto markets as some were previously stating, at least not according to the recent reduction. We don't have many periods like this that we can really go off of when analyzing crypto markets and when analyzing equities. And if you analyze equity markets, you'll find the same. You saw increased volatility when the Fed started to reduce the balance sheet. That was where some concern came in. But still, you would still have significant rallies and the markets would still hold up quite steadily, especially even during the interest rate hikes that really didn't spook markets that much. So, big thing I want to emphasize here, guys, is that we can turn to history to start to get these answers. We don't have to assume that it's completely directional one way or the other, depending on what the Fed does. Assets generally can continue to move. Now, I'm going to spend some time here in a moment to explain why that is. Why is it that the Fed, even though they have such an impact on the economy and asset prices, why assets can continue to rise? Before I do that, I do want to share some exciting news with you guys for our sponsor today, iTrust Capital. So as you guys know, they're one of the leading IRA providers in the cryptocurrency space if you're looking to invest in crypto and defer any tax obligations so you don't have to worry about that for your portfolio until a later date. But one important thing that I want to share with you guys is that they're giving away 2 tickets to the Bitcoin Miami conference. If you guys haven't heard about it, it's one of the largest Bitcoin conferences of the year, and they're going to be giving away a ticket to one of you guys who are listening here on the channel, as well as a Dash Report subscriber. So if you guys are interested, you can either, in this case, use the Google form down below to apply for it, and we're going to pick a random winner. Or if you guys are interested to increase your chances, you can also download and sign up for the Dash Report in this case to be able to get access to a potential free ticket to Miami. So hope to see you guys there and stuff. I'm going to try to make it out there either way. The iTrust team is a really great group of guys and stuff, and you should definitely try to make it out there and stuff if you're near the Miami area. All right, so let's go ahead and dive into this reason, guys. Why is it that equities could continue to climb higher? Well, over the last decade, corporations have found themselves with a happy problem. Record profits, solid profit margins continuously. With the advent of automation, of technology and software, increased productivity in the economy, and also as well a Fed that has been very easy in the sense of generating free, or not free, but easy money in a sense. Almost feels free sometimes. With all these macro factors, the balance sheet of corporations, U.S. non-financial corporations, so we're not even including the banking sector, right? We're talking about just typical businesses, consumer goods, software, technology, any field you can think of. The balance sheet of corporations has gone from around 2.5 trillion here at the turn of the end of the recession from back in 2008, all the way up to nearly 7 trillion. I would say by now, this is back in Q3 of 2021, I would say we're well onwards here towards 7.5 trillion. That's a lot of cash getting waned away by inflation, not earning practically any interest in a bank account. It doesn't matter if you're treasuries or any form of bonds, if you're just having your money sit in a bank account or a money market account, it doesn't really matter. Even in a CD, you're not going to get much yield on that 7 trillion in the forms in which it is right now. And I think what you're going to find as this pressure gets bigger and bigger, the corporate treasurers could be a major catalyst to turn against the tides here. With record quarterly profits, with this massive cash pile, corporations are going to have to look at alternative assets. Now, many of that capital, I just want to be very clear with you guys, much of it is probably going to go to stock buybacks and dividends to benefit the underlying shareholders. Wouldn't doubt that for a second. But even if a fraction of this, and I'm really talking, 200 to $500 billion, right? If even a sliver of this capital starts to go in towards buying positions in crypto assets, this could be enough to not only get us back up to the previous all-time highs, but outside of that as well, it could be enough to set the foundation for a retail-driven parabolic rally in prices, right? To get us back up to that 100, 200K range, 150K range, give or take, for Bitcoin. And this is why, again, we can't sit here and just say, oh, the Fed is starting to tighten here. That means that all assets are going to collapse. It's not a generally good assumption to make, because so long as there is cash in the system that is looking for a home, it's looking to be exchanged, and outside of that, there is inflows into the crypto space with that cash, prices will go up. So long as inflows outpace outflows, and so long as we're clearing through the limit orders on the sell side rather than the bids in the order book, right? So again, there's a lot of things that could possibly keep us afloat, not only in valuations, but also that could drive valuations higher. I think one important lesson, if you're to take away anything from this video, is don't just assume that the Fed is the ultimate gatekeeper on the asset market. Now, when they print enormous amounts of money, yeah, it's pretty stupid to bet against them and say, oh, the bear market's coming and this and that. No, we've seen every time and time again that when the Fed's printing, you better be in assets to protect yourself, or you're going to be losing a lot of purchasing power. But when the Fed starts to reduce, it not only talks a lot more than it walks, but outside of that as well, any kind of tightening usually doesn't last very long. If you don't believe me on that, and again, might have more of a bearish thesis, well, just take a look here at history. It's usually a vertical line upwards, slight increase over time, neutral, with slight periods of time where it pulls back, and then of course, easy money returns. The Federal Reserve has been playing this game for years upon years and decades upon decades. And it really isn't beneficial during these periods of time to start thinking, oh my God, it's time to start trading out of Bitcoin, because history has shown us that the opposite is generally true. So anyways, guys, I've rambled on enough. If you like this video, whether you agree or disagree, totally fine, but consider dropping a like if you found it to be a really good candid opinion on things, maybe a refresher on your perspective on things. And if you guys are interested, again, feel free to fill out that form for the Miami conference to see if you can win a free ticket. There's no cost to it to apply. And if you guys are interested in, well, like this kind of macro analysis, you can always check out the dashboard down below in the description. It's a great way to support the channel. And if you don't get tired of me rambling and are at this point of the video, might be up your alley. So anyways, guys, thank you all so much for giving me some time out of your day, and I'll see you all in the next video. Take care, everyone.